Okay, let's unpack this. We need to start by just acknowledging the sheer, almost terrifying scale of what our sources are laying out.
Right.
We're not talking about, a temporary trade spat or a market correction that's going to sort itself out in a few months.
No, not at all. You have to treat this moment with the historical gravity it actually deserves.
Exactly. We are standing at the threshold of a shift so big that it genuinely requires you to update your fundamental software for how the world works.
When these documents talk about the end of the unipolar financial world, that's not just some academic phrase. We have to frame this as a tectonic event.
Tectonic, that's the word.
Yeah, something on the scale of, say, the decline of the Roman Empire or when the British Empire lost its grip on global finance.
And when those eras ended, the rules for everything, for power, for trade, for just preserving your wealth, they changed completely.
Utterly. And everyone had to update their operating system. This is that moment. This is it for our generation.
So our mission today is pretty simple. The sources we've looked at, they paint this picture of an inevitable global bifurcation.
A great split.
A great split into two competing economic operating systems. And if the very infrastructure of the world economy is fracturing into two hostile regimes, well, your current financial plan is probably built on a fault line.
It is.
So we need to pull out the essential, actionable insights you'll need to navigate this whole transition.
We're seeing the death of that unipolar world, that system that's been in place since World War II, where the dollar was the only real anchor.
Where everything flowed through Western institutions.
Exactly. Through SWIFT, through New York settlement banks, that whole era, about 80 years, it demanded that everyone play by the same rules. And the sources are now showing very clearly the two separate systems being built to replace it.
And here's the core conflict that defines that split, and it's a brilliant way to think about it. The world is basically making two different bets on what has value. One side is betting on physics, and the other side is betting on digital energy, on code.
It's the analog world versus the exponential digital world.
And the sources are crystal clear. The bridge connecting those two worlds is being taken apart piece by piece right now. You just can't afford to be caught standing in the middle.
Right.
So let's start with that hard reality. Globalization, at least the version we all grew up with, is dead.
It's over. For the last, 2 generations, we've operated on the static assumption that supply chains would always chase the lowest cost, capital would always flow freely.
And that the dollar was the universal language for all of it.
Right. That stable unipolar foundation, it's gone. We are now definitively navigating a bipolar world.
And that shift from unipolar to bipolar, it's not just semantics, it's a shift from a kind of enforced unity to a systemic divergence.
That's a perfect way to put it. Before, U.S. sanctions had global reach. U.S. monetary policy set the price of money for the whole world. In this new bipolar environment, that control mechanism, it starts to get leaky. And eventually, for a huge part of the world, it just becomes irrelevant.
So the sources identify these two competing operating systems. And they're not just built on different economic models, but on what seems like completely incompatible ideas of value and trust.
Fundamentally incompatible.
Okay, so let's define them. This is the map we need to follow. On one side, we have Bloc A, we can call it the East, the expanding BRICS alliance. And their bet is on physics. And this isn't just a preference, it's a strategic choice to build their whole economic house on things that are tangible, things that are materially scarce.
Real stuff.
Real stuff. Gold, industrial metals like copper, strategic energy like oil, natural gas, and things like wheat and productive land. They're prioritizing value you can physically hold, something you can't just conjure up with an algorithm or a printing press.
And on the other side, you have Bloc B, the West, the G7 nations, and they are pivoting their entire future to mathematics and code.
Or what the research calls digital energy.
Exactly, and we should clarify what that means. Digital energy is the economic value you get, not from physical stuff, but from proprietary algorithms, from monetizing data, from massive intellectual property portfolios.
And cryptographic networks.
Like Bitcoin.
And cryptographic networks.
Right.
The West is making a huge bet that the power of technology, of network effects, and exponential growth will ultimately be a stronger, more enduring source of global power than just controlling physical resources.
Now, I'm curious, because it's so easy to talk about this like it's some prediction for 2040 or 2050. But the sources all stress that this is happening right now.
Oh, absolutely.
What's the most concrete, undeniable evidence that this bifurcation is happening as we speak?
Well, the evidence isn't hiding. You just have to look at the plumbing of the financial world, which is global trade settlement. It's being completely overhauled.
Right.
Look at the deals between major commodity producers, led by Russia, and the massive buyers, especially China. They're doing these enormous sales of oil and gas, and they're settling them not in dollars, which is the tradition, which has been the rule for decades.
For decades, they're settling them in yuan or in baskets of their own local currencies. This isn't a preference. This is the active, deliberate construction of an alternative settlement rail, one designed to operate completely outside the reach and the sanction power of the U.S. financial system.
And what's the move from the other side, from Bloc B? The U.S. and its allies have to be making an equally strategic countermove.
They are?
The documents highlight this really clear, focused pivot toward grabbing domestic control over critical digital infrastructure. I mean, why the sudden, almost frantic embrace of, say, domestic Bitcoin mining, all centralized in places like Texas?
Because it's a strategic imperative. If the U.S. is acknowledging, even implicitly, that it's losing the physical resource war, which is Bloc A's home turf, then it has to ensure absolute dominance over the infrastructure of the new digital economy. That's Bloc B's turf. By controlling the global Bitcoin hash rate, the raw computing power that secures that network, and by regulating the key stablecoin issuers, like USDC, the U.S. is trying to own the digital highways of future commerce.
So they're basically ceding the territory of physical stuff.
In a way, yes.
And planting their flag right on top of the digital mountain.
That's the play. The bridge between these two empires isn't just starting to burn. The sources say the structural supports are failing daily.
Okay, so if this is all happening right now today, what does this mean for you, the listener, who woke up this morning owning a traditional 60-40 portfolio?
Ah, the 60-40.
Yeah, 60% stocks, 40% bonds. This is the core connection to everyone's financial life. We have to call this the 60-40 warning.
Look, if you are holding that standard 60-40 map, you are navigating by constellations that have already collapsed. That portfolio was designed for the Uni-Polar world. It was built on assumptions of global stability, predictable monetary policy, and, most importantly, a negative correlation between stocks and bonds.
Meaning when one goes down, the other goes up. The bonds are your insurance.
That was the expectation, yes. When the economy and stocks suffer, U.S. Treasury bonds would be your safe haven. In a bipolar world, a world of economic warfare, fractured supply chains, resource nationalism, that correlation is fundamentally broken.
So the bonds are no longer a universal safe bet. They are now, as the sources suggest, a very specific claim on one particular nation's future solvency, a nation that might be in a fight.
Precisely. Your bond portfolio just transformed from a passive, boring diversifier into a very active political statement. It's a liability, and its value is directly tied to the outcome of this geopolitical game. We'll get more into why bonds become a weapon later, but the immediate takeaway is just stark. The rules that made the 60-40 a smart play are now obsolete. Relying on it today is just exposing yourself to massive concentrated risk.
Okay, let's go deeper into Bloc A, this Eastern alliance.
Yeah.
The philosophy is trust physics. But what's really driving that? Is it just a philosophy, or is it a direct and maybe painful reaction to the West?
No, it's 100% a reaction. It's born out of a very deep-seated distrust and, frankly, a fear of financial weaponization.
Right.
The BRICS nations, especially Russia and China, they look at the Western financial system and they see something that is inherently fragile. It's based on, seemingly infinite quantitative easing, and it's backed by nothing but faith.
And then 2022 happened?
And then the freeze of Russian assets in 2022 confirmed their absolute worst fears. It showed them that any dollar or euro asset they held could be instantly weaponized, seized just by political will.
So when they say trust physics, it's literal.
It's completely literal. It means they have to prioritize tangible value because code, derivatives, printed promises, you can't sanction them, you can't eat them, and they can't heat your home in the winter.
And that philosophy is showing up in how they're actually building this commodity-backed system. The most obvious sign the sources point to is this massive global trend of central banks just hoarding physical gold.
It's not just shuffling reserves around. This is a clear strategic move.
Right.
The pace of central bank gold buying in just the last few years has been staggering. I mean, we're talking record highs not seen since the Bretton Woods system fell apart.
Wow.
It shows a synchronized global de-risking away from sovereign debt, specifically U.S. debt, and a move toward the ultimate neutral physical collateral. These banks are prioritizing something that's liquid and fungible in a world where political trust has just evaporated.
So they're basically signaling to the world, we no longer trust the guy who prints the global reserve currency.
That is the signal, loud and clear.
And this gold buying is being backed up by the changing trade landscape. We mentioned the petro-yuan, but maybe we should talk about the scope of it. This isn't just a few isolated deals.
No, it's a systemic effort to settle trade completely outside the U.S. dollar system. Think about the logistics of it.
Okay.
We're talking about major oil producers, even some that were traditionally Western allies, now agreeing to accept payment in yuan or even the buyer's national currency and bypassing SWIFT entirely.
Which requires a whole new plumbing system.
A massive parallel clearing infrastructure. And the whole point is to create redundancy and, crucially, to deny the West the ability to enforce sanctions by itself.
Because the U.S. can sanction a dollar transaction.
Right. But it's totally powerless to sanction a direct yuan for oil deal that's settled bilaterally between two other countries. This new infrastructure is the literal foundation of Bloc A's economic sovereignty.
So the end goal for Bloc A, according to these deep dive documents, is to create a new multilateral trade currency. The nickname they're using is the unit.
The unit, yeah.
This is their direct counteroffer to the dollar. How is this thing supposed to be built? And why is its composition so critical?
The proposed design of the unit is a direct insult to fiat currency. It's designed to be pegged not to the political promises of any one country, but to a guaranteed basket of hard physical assets.
Back to physics.
Always back to physics for them. The sources emphasize gold and oil as the main weights, making up maybe 60% of its backing. The other 40% would be pegged to the local currencies of the BRICS members. The composition is everything. It's meant to ensure that every single unit of trade value is collateralized by something tangible and scarce.
So if you want to trade with Bloc A,
you have to bring something real to the table. Real material value, not just promises or printed paper.
that sounds incredibly difficult to actually pull off, though. I mean, the BRICS nations are so diverse: Brazil, India, South Africa, China, Russia. Do the sources get into the huge internal coordination problems they'd faced trying to launch the unit?
They absolutely do. The research points to this as Bloc A's greatest weakness: systemic trust and internal stability.
Right.
I mean, China and Russia might share the goal of de-dollarization, but their long-term economic interests are wildly different. The success of the unit depends heavily on China being willing to manage its huge trade surpluses in local currency, and the other members being willing to give up some monetary control to this new basket.
But for now, the fear of the U.S. is stronger than their fear of each other.
For now, yes. The shared fear of U.S. sanctions is acting as a temporary but very powerful glue, holding the whole project together.
So let's bring it back to the listener. If you're trying to position your portfolio for this reality, what's the clear takeaway? If you're betting on Bloc A to survive or even thrive, what assets are essential?
The implication is you need to place a significant insurance bet on the enduring value of physics. Plain and simple.
So owning commodities.
Owning commodities, and we mean physical, tangible assets. Energy producers, strategic industrial metals, copper, nickel, lithium precious metals like gold and silver, and productive land. This is essentially your hedge against the victory of resource nationalism.
Because if Bloc A succeeds in controlling those global inputs,
and if they successfully decouple the price of those resources from the dollar system, then owning those resources becomes the ultimate protection against Western inflation and potential systemic collapse. It's a fundamental bet on the simple reality that human civilization can't function without basic materials, no matter which operating system is winning.
All right, let's pivot now to Bloc B, the Western Alliance.
Yeah.
And we have to be honest about where they're starting from. The sources confirm the U.S. and its allies have, outsourced a lot of their manufacturing, sold off key strategic resources.
There's a deficit.
There's a real deficit in the physical world that Bloc A now controls.
That deficit is very real, but the West is pivoting based on its core strength. When you look at what's left, what the U.S. is betting its entire future on, it's three incredibly powerful assets.
Okay, what are they?
One, the deepest, most sophisticated capital markets in the world. Two, overwhelming military power. And three, most critically, unparalleled technological and computational dominance.
So their new philosophy, this trust code mindset.
It's based on the belief that connectivity, speed, intellectual property, and algorithmic efficiency can actually overcome physical scarcity.
This pivot to a financial system backed by digital energy, it means they're leveraging intangible things. We're talking IP, AI, and suddenly embracing assets they used to be very skeptical of, like Bitcoin and stablecoins.
And this isn't random. It's a highly strategic choice to maintain financial dominance by controlling the architecture of the future economy.
The strategy all comes down to controlling the rails, is that right?
It's all about the rails. The West gets that if they lose control over commodity pricing, they absolutely must control how money moves.
Okay.
By suddenly embracing something like USDC, they're solidifying their grip on the stablecoin market, which is essentially a digital dollar that can travel anywhere in the world instantly.
And the Bitcoin mining.
By bringing Bitcoin mining on shore, they bring the security and control of the world's most powerful, neutral digital network inside the regulatory fence. The goal is to embed their financial system into the technology stack itself.
So if all global commerce starts flowing through stablecoins and settling on cryptographic networks,
Then the West maintains its influence, even if oil is being priced in yuan.
so this is the massive network effect bet.
Mhm.
Block B is basically saying, yeah, okay, Block A controls the raw materials, but we control the proprietary operating systems, the Googles, the Amazons, the giant data centers that manage all the world's information and transactions. And the utility of that network is ultimately more valuable and grows faster than a physical barrel of oil.
Precisely. Physical commodities are finite, they're slow to move, they require massive, vulnerable physical infrastructure, but code and data, they're infinitely reproducible, they move at the speed of light, and they benefit from these huge compounding returns once a network hits critical mass.
It's an economic moat.
The West is betting that the utility and efficiency of its digital platforms and crypto infrastructure, their network effects, will create an economic moat so wide that Block A will always have to engage with it, even if they don't want to. This becomes the new source of Western power in the bipolar world.
So for the listener, what's the investor takeaway here? If you're betting on this digital pivot, what are you actually buying in Block B?
This is the high-growth, high-risk side of your portfolio, owning technology, and specifically the monopolistic foundational pieces like the top AI companies, the advanced chip manufacturers,
Picks and shovels of the whole digital stack.
the absolute core ingredients, and the neutral crypto assets like Bitcoin. This is a bet on exponential growth. You're betting on the West successfully reinventing itself as the dominant digital empire. This side of the portfolio is designed to capture the incredible upside from network effects and technological acceleration, which historically just blows past the growth rate of physical commodities.
Okay, so this is where the analysis shifts from, abstract philosophy to immediate risk management. And this is where it gets really interesting and frankly pretty dangerous. The biggest risk during this transition isn't which side wins. It's the extreme friction that's created as these two massive economic blocks pull apart. And the result, the sources say, is the construction of a financial Berlin Wall.
And this wall is built out of one thing: rising capital controls. We just have to throw out the old idea that capital will always flow to where the returns are best.
That's not how it works anymore.
Not in a bipolar world. Capital flow becomes a weapon. We're talking about systemic firewalls designed to stop Block A's capital from funding Block B's tech and vice versa, stopping Block B's financial system from helping Block A's resource independence.
Can you give us some concrete examples? What should the listener expect to actually see as this wall goes up?
The sources map out a pretty rapid implementation of these restrictions. From the Western side, you'll see the U.S. banning investment, first by institutions, then by regular citizens, into specific Chinese stocks.
Especially tech or military-linked companies.
Exactly. Through delistings, through executive orders. And that functionally locks huge pools of Western capital out of Block A stock markets.
And the response from Block A?
Resource nationalism. They hit back by banning or heavily restricting the export of strategic materials. Think rare earths, specific industrial metals, things the West absolutely needs for chips and high-end military hardware. It's a direct attack on Block B's digital supremacy.
So once these firewalls are up, the question of sovereignty of assets becomes absolutely critical. This is a point people miss a lot in market analysis. What does it mean for you, the individual investor?
Sovereignty of assets just means recognizing that an asset is always governed by the laws of the place where it is legally or physically located.
Okay, so an Apple stock is a U.S. asset.
It's governed by U.S. law, a Block B asset. An Alibaba stock is governed by Chinese law, a Block A asset.
Yeah.
Now, here's the practical danger for you. If your retirement fund, which is based in the U.S., owns Chinese tech stocks, and the U.S. government bans investment in those companies,
that asset suddenly becomes worthless to me.
not worthless, but illiquid for you. It still exists, but the law now prohibits you from trading it. You are functionally stranded on the wrong side of the wall.
Wait, let's drill down on that. What if I own those assets through an ETF or a mutual fund? Doesn't that protect me from that direct jurisdiction risk?
Not completely. The fund itself might be domiciled in the U.S. and protected by U.S. law, but the underlying asset is still subject to the laws of its home country.
Right.
Even if the fund is forced to sell the Chinese asset, the U.S. investor is still getting the sanctioned value of that asset, probably at a huge discount. And it introduces this new layer of regulatory risk. If the U.S. government decides to sanction a whole sector globally, your entire ETF could be affected.
So you have to know which empire holds the ultimate legal claim over your property.
The research says that transparency of domicile is paramount now. You have to know.
The sources use this really chilling reference to the 2022 freeze of Russian assets to drive this point home. Why was that event such a catalyst for this whole split?
The 2022 freeze was a global financial declaration of war.
That's a strong statement.
It was hundreds of billions of dollars in sovereign central bank reserves.
Yeah.
Assets that were always considered the safest things in the world were made inaccessible to their owner instantly. This wasn't just politics. It was a demonstration that capital controls are the ultimate financial weapon.
And it sent a message to everyone else.
It sent a signal to every single nation outside the G7, no matter who their friends were, that holding your reserves in U.S. or European assets carried an existential risk. That single event did more to accelerate the BRICS' efforts to build their own system than anything else.
And this leads us right to the most destructive outcome for traditional portfolios, the death of bonds. We need to explain why that 40% in the old 60-40 is no longer a safe diversifier in this new warring world.
In the old Uni-Polar world, U.S. Treasuries were the risk-free asset. The issuer was stable, dominant, the system was unified. In this new bipolar context, that long-term bond, especially a 10 or 30-year bond, is completely redefined. It is not an asset that diversifies your risk anymore. It is a claim on a specific government that is now in a deep economic conflict, and it's facing hyperinflationary pressure from printing money and geopolitical risk from the resource bloc.
But if the U.S. government uses its debt and the dollar as a weapon against the East, wouldn't that make the debt safer for someone in the U.S. holding it?
The sources say it's actually the opposite. The weaponization process itself creates massive volatility and duration risk. If the U.S. prints trillions of dollars to fund its own strategic needs, the purchasing power of your bond just collapses.
And on the other side.
If Bloc A succeeds in creating alternatives like the unit, global demand for treasuries falls off a cliff. That drives up interest rates and crushes the face value of the long-term bonds you're holding.
So the bondholder gets squeezed from both sides.
From both sides. Inflation eats the real value, and geopolitical competition kills the price. It becomes a liability at the state, not a safe haven for the citizen.
So, what does this all mean? If the world is splitting into two hostile, weaponized economic zones, the most urgent need for global trade has to be a neutral reserve asset.
Something that can safely cross that financial Berlin Wall.
Exactly. Something both empires can trust, or at least something that's beyond the unilateral control of either one.
And historically, that was gold. Gold did that job perfectly. It's universally seen as money. It's independent of any country. Enemies traded gold with each other for thousands of years because its value is just inherent. It was the original neutral money.
But the sources really stress why gold has its limits in a 21st century economic war. I mean, I'd argue gold is still gold, but what are its real-world limitations in a digital conflict?
The limitations are logistical and political, and they're made worse by the digital age. Gold is physical. It is incredibly heavy, it's difficult, and extremely expensive to move in the kind of quantities you need for sovereign trade.
Right, we're not talking about a few bars.
We're talking about tons. And in a time of active blockades or military tension, moving that physically is a huge security risk. And most importantly, big physical stores of gold can be confiscated or blocked. That lesson has not been lost. In a digital economy that needs instant high-volume settlement, gold is just too slow and carries too much physical risk to be the only neutral rail.
And this is the exact moment where the geopolitical case for Bitcoin really comes into focus. It seems to solve the limitations of both the dollar and gold at the same time.
It hits three critical needs. One, like gold, it is finite. Its scarcity is guaranteed by math, and anyone can audit it.
Okay.
Two, like the modern dollar and fast-moving capital, it is digital. It moves instantly, 247 across any border with an internet connection.
And the third, Most important point.
And the third, which is the most critical point in this world of zero trust, is that it is neutral. It is a decentralized, permissionless network. It's owned by no single government, so it's immune to unilateral sanctions or freezing attempts from either Bloc A or Bloc B.
So its very neutrality positions Bitcoin, according to these documents, as the default swift alternative for settling sovereign trade.
Can we talk about the mechanics of that? I mean, how does a country like China or a big resource producer like Brazil use a super volatile asset like Bitcoin for huge trade deals?
The volatility is the price you pay for guaranteed trustlessness. The key is the settlement layer. A transaction, let's say China paying Brazil for iron ore, can be settled instantly in Bitcoin without needing a bank, a centralized ledger, or permission from Washington or Brussels.
And the volatility, the price swings.
You manage that risk. You can immediately convert it to your local currency the second you receive it, which minimizes your exposure time. But the core function, the utility, is that you bypass the political risk completely. It becomes this necessary clearing layer that allows companies, neutral nations, and even the two warring empires to trade for the necessities of life without having to bend the knee to the other's jurisdiction.
The sources have this line where they theorize that the value of this neutral money goes to infinity.
Because the supply of a trustless global settlement asset in a world without trust is effectively zero.
And that's the ultimate value proposition. The world has just created this massive, immediate demand for a financial asset that is guaranteed to be hostile to centralized control. Our current global system is built on the assumption of trust in banks, trust in institutions, trust in the rule of law. When that trust totally breaks down between two giant, hostile empires, the only asset that was specifically designed to work without trust, Bitcoin, becomes absolutely indispensable. It's the digital bridge between the commodity-rich East and the network-dominant West. It offers a path for both physics and code to exchange value without giving up their sovereignty. ###shit6. The bipolar portfolio and scenario planning.
Okay, so knowing all of this, that we've got these two empires forming, one betting on the scarcity of physics, the other on the speed of code, how do you, the investor, actually build a portfolio that can last? The sources are very clear about the mistake of going all in on one side.
Going all in is basically a bet that you can predict the future, which is impossible. If you put 100% of your money into tech stocks and digital assets, Block B,
Right.
you are exposed to catastrophic risk if Block A successfully cuts off critical minerals or if geopolitical tension leads to cyber warfare and grid failures.
And the other side.
Conversely, if you're 100% in gold and physical resources, Block A, you completely miss the exponential compounding growth of AI, of computational power, of the entire digital economy that Block B controls. True resilience means you have to be diversified across these two new necessary worlds.
Which means we need a new investment strategy.
Yeah.
The barbell strategy. The idea is to have two extreme heavyweights on either end that can survive the worst-case scenarios while you deliberately get rid of the soft, vulnerable middle.
The barbell strategy is designed for exactly these kinds of divergent, volatile times. So weight A is the hard side. This is your insurance policy. The recommendation is a pretty substantial allocation, 20–30%, to physical gold and silver, energy commodities, and maybe some strategically located productive land or real estate that isn't drowning in debt.
And the purpose of weight A is purely defensive.
It's your protection against a dollar collapse, hyperinflation, and the victory of resource nationalism. It's the wealth preservation part of your portfolio.
And on the other end of the barbell, weight B is the digital side. This is your aggressive growth engine.
Right. This is the mere 20–30% allocation to those monopolistic technology firms, the key AI players, the chip fabricators, and the necessary neutral reserve asset, Bitcoin. This side is designed to capture all the upside from the Western digital pivot and the acceleration of that digital economy.
Okay, so we have 20–30% on the hard side, 20–30% on the digital side. What about the rest? What about cash?
Well, the traditional role of cash as a safe haven is fundamentally redefined in this model. Cash is now just the pivot.
Pivot.
It's the lubricant you use to move between weight A and weight B when volatility creates opportunities. It is not a store of value anymore. Inflation will constantly eat away at its purchasing power. It is purely a short-term tactical tool you need for flexibility.
To really see the power of this barbell portfolio, we have to stress test it against the two most destructive financial extremes this bipolar world could throw at us. Let's start with scenario one. Dollar hyperinflation.
Okay.
The West gets desperate, they print money to infinity, their debt spirals, and the purchasing power of their currency collapses.
If the West goes the inflation route, the sources say the result is the ultimate proof of the barbell structure. The real value of currency goes to zero, but assets with guaranteed scarcity gold, physical commodities, and Bitcoin, they all skyrocket in dollar terms.
So what the sources call infinity.
To infinity. Real estate and land hold strong because they're physical, but the cost of living explodes. And critically, in this scenario, your fixed income assets, your bonds, and any consumer businesses that rely on global supply chains are completely wiped out. Their input costs rise faster than they can possibly raise prices.
But the barbell is safe because both ends are inflation hedges.
Both ends are explicitly designed to be inflation hedges.
All right, now for the opposite extreme. Scenario 2, deflationary crash. Global trade just freezes up. Blockades, capital controls tighten, and a violent credit contraction leads to a deep global depression. Mass liquidations.
A deflationary shock always has a brief period where cash is king, because everyone needs liquidity to cover their debts and margin calls. But that moment is short-lived.
What happens after?
As all the bad credit gets liquidated, the world desperately needs new collateral to reboot the system. And gold shines. It becomes the universal, non-debt-based collateral, holding its value when all the paper assets fail.
And Bitcoin.
Bitcoin, being tied to liquidity, will probably have a dramatic, violent crash along with every other risk asset. But then it rebounds quickly and dramatically because it's the only accepted necessary underlying system for future transactions in a world with no trust.
So the barbell structure gets you through the initial shock with your cash and physical collateral.
And you're perfectly positioned to capture the rebound of the new digital rails.
The conclusion here seems absolutely critical for anyone's long-term planning. In either of these extreme scenarios, the asset class that gets completely crushed is the middle.
It's the systemic risk zone. The middle is anything that relies on the stability and free flow assumptions of the old unipolar world. We're talking long-term government bonds, most corporate credit, diversified index funds full of non-essential businesses, mediocre real estate.
Why are they so vulnerable?
Because they lack the foundational scarcity of the hard assets, and they lack the exponential growth potential and the necessary utility of the digital assets. They are caught in the destructive friction between the two empires, and the research is clear on this. The edges survive. The middle gets pulverized.
Yeah.
Hashtag tag tag outro.
Wow. This has been a complete teardown and rebuild of how we should be looking at global finance. Let's try to pull this all together into a definitive playbook for the listener for this brand new bipolar reality.
First, you have to accept the split. Globalization is over. The future is defined by reshoring, bringing critical production home, and resource nationalism, where countries fiercely guard their vital materials. Just stop planning for things to go back to normal.
Second, own the bridge. Bitcoin is the most asymmetric bet in this whole environment because it's the necessary neutral reserve, the trustless settlement layer that both the commodity-rich East and the tech-dominant West need to trade with each other without giving up political control.
Third, own the base. Physical gold and silver. This is your foundational insurance policy. It's the floor under the whole structure. It's proven to preserve wealth through every systemic collapse for 5,000 years. This is your hedge against the printing presses of Block B.
And finally, number 4, avoid the middle. That 60-40 map is obsolete. Get out of long-term government bonds and non-essential, non-monopoly stocks. They are exposed to financial weaponization, and they just don't have the resilience for this new era of divergence.
The core conclusion of all our analysis really remains. You do not have to pick a side in the war between the physics empire and the digital empire. Your survival and your prosperity depend on strategically owning the assets that both sides desperately need to keep their economies running.
The hard base and the neutral bridge.
The hard base and the neutral bridge.
And this leads us to the final provocative thought. Something every listener has to think about when they position their bridge asset. If the world really is splitting into two highly sophisticated, hostile blocks, the resource empire and the digital empire, and Bitcoin is the indispensable permissionless bridge.
The question is, can that neutrality last? Can that cryptographic bridge really stay permissionless if its very function starts to threaten the sovereignty of these two global powers? The sources point to two main ways the bridge could be attacked.
1. What happens if Block B, the tech-dominant alliance, uses its control over computing power and energy to gain a decisive majority of the Bitcoin mining hash rate? If they could censor transactions, the neutrality of the bridge is gone for the other side.
And 2, What happens if Bloc A, which controls the physical world, decides to disrupt the core global internet infrastructure? The undersea cables, the satellites, the power grids that the digital bridge needs to even function? That would be a form of physical censorship. When the prize is global empire, the bridge becomes the #1 target.
So the investor has to constantly ask, what happens to the value of this trustless, neutral asset? If the warring empires finally decide it's politically easier to just blow up the bridge than to rely on it, that is the risk we have to monitor as we navigate this bipolar future.
A compelling question, and it frames the volatility we're all going to face.
A lot to think about. That was the deep dive.